All right, folks, ready to kind of step outside that comfort zone.
Yeah.
Today, we're diving deep into a world where risk and reward are like two sides of the same coin. And our guidebook. It's this fascinating little book called the Zurich Axioms. Think of it as a playbook passed down through generations of those notoriously savvy Swiss bankers.
And you know what's fascinating about these axioms is they really challenge, that conventional financial advice. It's not just about playing it safe and diversifying your portfolio.
So that's not just like put your money in a savings account and forget about it.
No, not at all. These axioms are all about understanding that to really kind of make a difference in your financial journey, you've got to be willing to embrace a bit of risk. Calculated risk, of course.
Okay, I'm intrigued. Where do we even begin with this?
Well, the first axiom kind of sets the stage, and it's a powerful one. Always play for meaningful stakes. Think about it. Why play small when you can aim for substantial gains?
So it's not just about betting what you can afford to lose.
It's about understanding the power of leverage, where a small, calculated bet can potentially yield significant returns. You see, the Zurich Axioms are saying, think bigger.
So it's about understanding that to see substantial growth, you've got to be willing to put something significant on the line, within reason, of course.
Precisely. The book illustrates this with a great story about two friends. Sober Sylvia, who played it safe, and Mad Mary, who embraced, the adventure of risk. You see, Sylvia put her money in a savings account. Modest, but guaranteed returns. But Mary, she took a leap of faith, investing in the market, accepting the inherent volatility that came with it.
Oh, I see where this is going. Sylvia's playing it safe, slow and steady. Mary's out there riding the waves.
Exactly. And while Sylvia initially scoffed at Mary's approach, Mary's response perfectly captures the essence of this axiom. She said, yes, I have a loss, but look what else I've got. I'm having an adventure.
I love that. It's not just about the potential financial gain, but the journey itself, the excitement of stepping outside that comfort zone.
Exactly. And that leads us to the second axiom, which cautions, always take your profit too soon.
Now, this one really makes you think. It's like a preemptive strike against that greedy voice we all have.
It is. You see, greed can be a real trap for investors. This axiom emphasizes the importance of discipline, recognizing that market peaks are often closer than we think.
So you're saying it's better to walk away a winner, even if it feels a little too soon, rather than risk losing those hard-earned gains, chasing an even bigger win.
Precisely. And the book tells the story of Alice and Harry, who made a hefty profit on their home during a real estate boom. But instead of selling and securing their gains, they held on, hoping for even bigger returns.
Oh no, this doesn't sound good.
It wasn't. The market took a downturn. Alice and Harry ended up losing a significant portion of their initial profit. They got so caught up in what they might gain, they failed to protect what they already had.
That's a tough lesson. A real reminder that sometimes the smartest move is knowing when to walk away. But what happens when things go south? Like really south? How do you handle a losing streak?
Well, that's where the third axiom comes in. And it's a stark reminder to act decisively. When the ship starts to sink, don't pray, jump.
Whoa, okay. That's pretty dramatic. No room for sentimentality, I guess.
Not when it comes to protecting your finances. This axiom is all about damage control, learning to cut your losses before they become insurmountable.
So it's about recognizing when a venture is failing and having the courage to move on, even if it means accepting a loss.
Exactly. Holding onto a sinking ship only delays the inevitable and prevents you from reinvesting in something, with more potential. The book shares a story about Susan Garner, a banker who initially struggled with accepting losses. It wasn't until she learned to lose, to walk away from a failing venture, that she truly found success.
I'm sensing a theme here. Control your emotions. Be decisive. These aren't just financial strategies, they're valuable life lessons. So how do we navigate these unpredictable waters of finance? Can we rely on expert predictions?
That brings us to the next axiom, which throws a real wrench in those neat and predictable forecasts. Axiom 4 states, human behavior cannot be predicted. Distrust anyone who claims to know the future, however dimly.
Ooh, this one hits close to home. We've all fallen for those, like guaranteed returns, promises before.
It's a common trap, especially in a world obsessed with predicting the future. But this axiom reminds us that nobody, not even the most renowned financial guru, can truly predict the future, especially in a world shaped by, the unpredictable nature of, humans.
So should we just throw away our charts and our crystal ball?
Essentially, yes. This axiom encourages a shift away from trying to predict the future to reacting to the present. It's about developing a flexible strategy that allows you to adapt to changing circumstances, rather than clinging to outdated forecasts. Remember the 1929 stock market crash? Leading economists were proclaiming a permanently high plateau for stock prices. Just a few months later, the market collapsed.
Ouch. Okay, so relying on predictions is out. But how do we even begin to make sense of the financial world if it's so unpredictable?
That's where the fifth axiom comes in, and it's a real mind bender. Chaos is not dangerous until it begins to look orderly.
Okay, I need a minute to wrap my head around that one. You're saying the real danger lies in seeing patterns where none actually exist.
Precisely. The financial world is inherently chaotic. Imposing a false sense of order on this chaos can lead to complacency, missed opportunities, and ultimately bad decisions. It's like that man in the book who thought he discovered a foolproof pattern in the price movements of IBM and Honeywell stock. He was convinced he cracked the code, started making significant bets based on this perceived pattern.
Let me guess, he lost a lot of money.
Unfortunately, yes. The pattern he thought he'd identified was nothing more than random chance. This axiom warns against falling for that illusion of predictability, that tempting but often misleading feeling that we've somehow figured it all out.
So it's not about denying that patterns can emerge, but rather being cautious about assuming that they'll continue indefinitely.
Exactly. It's about maintaining a healthy skepticism, understanding that what worked yesterday might not work tomorrow.
Wow, these first 5 axioms, they're packed with some insightful and sometimes counterintuitive advice. But there's more, right? Tell me about these minor axioms you mentioned earlier.
Absolutely. While the major axioms lay the foundation, the minor axioms offer further nuggets of wisdom, kind of delving deeper into the nuances of risk-taking, decision-making, and wealth building.
Okay, before we get into those minor axioms, let's take a moment for our listeners to, kind of absorb these first 5. Think about how these principles might apply to your own financial decisions. Are you playing it too safe? Are you letting greed cloud your judgment? Are you clinging to outdated forecasts? Take a moment to reflect, and when we come back, we'll dive into the practical wisdom of those minor axioms.
Welcome back, everyone. Ready for some more unconventional wisdom from the Zurich Axioms?
Absolutely. I'm especially curious to see how these Swiss bankers tackled things like intuition and even superstition.
Right.
I mean, those seem like unlikely allies for calculated risk takers, don't they?
You'd be surprised. Let's start with axiom number 7. It delves into the often misunderstood world of intuition. It states, a hunch can be trusted if it can be explained.
Okay, so this is really interesting because we often think of, like, intuition as this almost mystical force that defies logic, right?
Yeah.
But the Zurich Axioms are suggesting a more practical approach here.
They are. They acknowledge that, intuition can actually be a valuable tool for investors, but only if it's rooted in some sort of rational framework.
So it's not about, like, blindly following every gut feeling you have.
Right.
It's about learning to differentiate between hunches that have a logical basis and those that are, well, maybe just wishful thinking.
Exactly. Think of a hunch as a form of compressed knowledge, a culmination of your experience, your observations. It can be a powerful guide, but only if you can, articulate that reasoning behind it. The book shares a great story about a successful investor, and his winning bets always seem to be based on pure hunches. However, upon closer examination, it turned out that these hunches were actually rooted in his subconscious awareness of very subtle market patterns. Yeah. Patterns he hadn't consciously recognized, but they were definitely informing his intuition.
So it's not about dismissing intuition altogether. It's about, like, honing it.
Right.
Connecting those gut feelings to a logical framework. That's fascinating. Okay, so what about superstition? I mean, does that play a role in these axioms?
Let's move on to axiom number 8. It addresses that very topic, and it bluntly states, do not seek supernatural help in your speculative ventures.
Okay, so no lucky charms or consulting astrological charts for stock picks.
Not if you're aiming for, consistent success. The Zurich Axioms really emphasize that relying on supernatural forces for financial gain is not only ineffective, but it can be quite disempowering.
It's like giving up control of your own financial destiny.
Exactly. The book even goes so far as to advise against praying for financial success. It argues that it fosters a dangerous sense of complacency. Remember, action is key.
Okay, so no relying on luck or divine intervention. But how do we manage those inevitable feelings of fear and uncertainty, especially when things start to get a little, turbulent?
Hmm.
Do the Zurich Axioms offer any guidance for those moments of doubt?
Well, axiom number 9 tackles that emotional roller coaster head on. It states, optimism means expecting the best, but confidence means knowing how you will handle the worst. Never make a move if you are merely optimistic.
Yeah, I think we've all been there, right?
Yep.
Swept up in that wave of optimism, convincing ourselves that, this time fortune's going to favor us.
It's a common trap, especially for those new to the game.
Yeah.
This axiom reminds us that while optimism can be very motivating, it's no substitute for a solid strategy, one that considers both the potential rewards, but also, those potential risks.
So it's not about being like pessimistic or anything, but it's about having a plan in place for when things don't go exactly as you hoped.
Precisely. True confidence stems from knowing how you'll handle that worst case scenario, having that clear exit strategy before you even begin. The book talks about Sam and Judy, a couple, and they were so brimming with optimism about this real estate venture, but they were so focused on the upside, they really failed to consider, the risks. They ended up buying this undeveloped land from a company with, well, let's just say a shaky track record. And they didn't really have a backup plan for when things started to unravel.
So their optimism kind of blinded them to the potential downsides, and they
Yeah.
didn't prepare for those possibilities.
Exactly. This axiom is a powerful reminder that even the most well-intentioned optimism needs to be balanced with a healthy dose of realism. And, you need a solid plan for managing those potential pitfalls.
That makes a lot of sense. Okay, so what about those those meticulous long-term financial plans that we often create for ourselves? Those 5-year, 10-year projections.
Right.
They give us this sense of control over our financial future. Do the Zurich Axioms support that kind of planning?
Axiom number 12 addresses this directly, and it might surprise you. It states, long-range plans engender the dangerous belief that the future is under control. It is important never to take your own long-range plans or other people's seriously.
Wait a minute. So are you suggesting that we throw out all those meticulously crafted spreadsheets and just kind of go with the flow?
Not necessarily. It's not about abandoning planning altogether. It's more about acknowledging the limitations of trying to predict and control events that are years or even decades into the future. Remember, as we've already learned, the future is inherently unpredictable.
So it's about embracing flexibility, being willing to adapt and adjust our course as circumstances change.
Exactly. The Zurich Axioms suggest that clinging too tightly to long-range plans creates a false sense of security. And it can actually hinder our ability to adapt to unforeseen opportunities or challenges. Think about George and Martha, a couple who meticulously crafted this long-range financial plan back in the 1940s. They followed it very diligently, but, life threw them some curveballs, unexpected expenses, job losses, shifting economic conditions. Their plan, which once felt like this roadmap to success, ended up being too rigid. It prevented them from adapting to those changes.
Their story really highlights the importance of remaining adaptable and not getting too attached to any single vision of the future.
Exactly. While planning is essential, it's crucial to maintain a certain degree of flexibility
Yeah.
and be open to revising those plans as new information and opportunities emerge.
These axioms really do challenge conventional thinking. I'm already starting to reevaluate some of my own financial habits and even, some long-held beliefs.
That's the power of the Zurich Axioms. They offer a really fresh perspective that can be applied to many different aspects of life, not just finance.
Okay, before we move on to the remaining minor axioms, let's pause for a moment and let our listeners kind of reflect. Think about your own approach to planning. Are your plans flexible enough to adapt to those changing circumstances? Are you maybe allowing emotions like fear or optimism to really drive your financial decisions? Take a moment to consider these questions, and we'll be back to explore even more of those insightful minor axioms. Welcome back to the final part of our deep dive into the Zurich Axioms. We've covered a lot of ground already, from embracing those calculated risks to the importance of staying flexible in an unpredictable world.
Yeah, and we've still got some fascinating minor axioms to explore. These little nuggets of wisdom offer some really practical advice for navigating those complexities of speculation and decision making.
I'm ready for more. What's next on our list of unconventional wisdom?
Well, let's talk about history. Often we try to predict the future by studying the past, assuming that those patterns will kind of repeat themselves.
Right, so that whole like history repeats itself.
Yeah,
Yeah.
exactly. But minor axiom V, titled "Beware the Historian's Trap," really cautions against this approach. It reminds us that while history can offer valuable lessons, it's a notoriously unreliable predictor of the future.
So we can't just assume that what worked before will work again.
Precisely. The context is always changing, and new variables they emerge constantly, making the past a really shaky foundation for predicting future outcomes. The book tells a story about a young currency trader who meticulously studied historical data. She identified this pattern she believed would repeat. She was so convinced by this historical analysis that she ignored other market signals.
Oh, I'm sensing this didn't end well for her.
Unfortunately, no. The market shifted in a really unexpected direction. She ended up losing a significant portion of her investment.
That's a good reminder to be cautious about, placing too much faith in historical patterns. They might not hold true in this ever-changing, landscape of the financial world.
Exactly. And it reinforces the importance of staying adaptable and open to new information.
Okay, so history is a guide, not a guarantee. What about those charts and graphs that investors love to analyze? Don't they offer some valuable insights?
Minor Axiom the Six addresses that directly, cautioning us to beware the chartist delusion. While charts can be very helpful tools for visualizing data, they can also create a false sense of order, leading us to see patterns that are nothing more than random
That's
fluctuations.
like those optical illusions, right? You see one thing, then another. Our perception changes, even though the underlying data remains the same.
That's a great analogy. The book warns against becoming overly reliant on charts, emphasizing that they should be used as supplemental tools, not the sole basis for making decisions.
So maintain a critical distance, question those seemingly obvious patterns,
Yeah.
and don't get too carried away by a beautifully formed trend line.
Exactly. Now let's talk about that tricky relationship between correlation and causality. It's a common mistake to assume that just because two things happen together, one must be causing the other.
Right. That's the classic correlation doesn't equal causation principle.
Exactly. Minor Axiom the Seventh tackles this fallacy head on. Remember the example of the man who noticed that the prices of IBM and Honeywell stock often moved in opposite directions.
Yeah, he thought he'd uncovered some like secret formula or something.
He assumed a causal relationship between the two stocks movements, when in reality it was just pure coincidence. The takeaway here is to be skeptical of any perceived um, cause and effect link, especially in complex systems like the financial markets.
So resist the urge to create those narratives to try to explain those correlations that might just be purely coincidental.
Now, let's revisit a topic we touched on earlier, emotional attachment to investments. Minor Axiom IX kind of delves deeper into this. It warns against getting trapped in a failing venture, due to those feelings like loyalty or even nostalgia.
It's like refusing to sell that declining asset because of some sentimental value attached to it.
Precisely. The book uses the example of this couple who held onto their home even though the neighborhood was, kind of deteriorating just because of their emotional connection to the property.
It's a classic case of letting sentimentality cloud your financial judgment.
And the Zurich Axioms stress the importance of objectivity, urging us to detach from our investments and make decisions based on a really clear-headed assessment of the facts.
So don't let those emotional attachments, however strong they might be, hold your financial well-being hostage.
Absolutely. And that leads us to minor axiom X, which advises never hesitate to abandon a venture if something more attractive comes into view.
So it's not just about cutting our losses. It's about being open to new opportunities, even if it means abandoning a project we've already invested in.
The Zurich Axioms really emphasize flexibility. They remind us that clinging to that sinking ship can prevent us from seizing a more promising opportunity.
It's like that entrepreneurial spirit.
Yeah.
You know, always be ready to pivot and adjust your course as the landscape changes.
Exactly. Now, for our final minor axiom, Axiom XV cautions against that common practice of averaging down. This is where you buy more of an investment as the price drops, hoping to lower your average cost, make it easier to kind of break even.
So essentially doubling down on a leasing bet.
In a way, yeah. And the Zurich Axioms actually advise against this strategy,
Mm-hmm.
arguing that it's often a form of denial, a way to avoid accepting that maybe the investment was just a mistake.
Throwing good money after bad, hoping to magically turn a losing situation around.
The book emphasizes that taking a small loss and moving on is often the wiser choice. It frees up your capital to pursue more promising ventures.
Wow. These minor axioms offer like a wealth of practical advice for approaching risk and navigating all those complexities of the financial world.
They're like a toolkit for sharpening those decision-making skills and becoming more savvy investors.
So to kind of wrap up our deep dive into the Zurich Axioms, let's remember those core principles. Embrace calculated risk, control your emotions, stay adaptable, and always, always question assumptions.
These axioms challenge that conventional thinking, and they encourage a more strategic and discerning approach to financial decision making.
And who knows? Maybe by applying these principles, we can all tap into a little bit of that Swiss bank of wisdom and unlock our own financial success.
Remember, the journey of wealth building is an ongoing one, full of twists and turns. The key is to stay informed, stay flexible, and never stop learning.
That's it for this deep dive. Keep exploring those unconventional paths, and we'll see you next time for another deep dive into a fascinating topic.